interesting topic today. I think it's going to be a little bit different than what you guys are thinking it's going to be. How to analyze a property. Yeah, I know that. Yeah. Okay, but we're all still doing it wrong. And we have a general idea, right? But we're still seeing all the time properties that are being analyzed wrong. If you're a veteran investor, you've been doing this for 10 years or longer, and you have multiple properties in a portfolio, you're probably doing it right. I shouldn't say that. But what I'm saying is people that have been doing this for 2, 3, 4 years and feel that they've got, a real hang on it, but yet we're still seeing the numbers coming in not quite right.
Let's be frank. It's tough sometimes to find exactly what we're looking for, right?
Yeah.
Like it's tough to find exactly the type of property in the right area that we want, that fits it checks all the boxes. And sometimes what we tend to do, and we're going to talk about this in detail, is we start to just smooth out and smudge those numbers a little bit. So we're going to talk about that today.
Yeah.
And some other things that, whether we've been buying properties for a long time, or whether we're just looking to buy our first property, some things to watch out for. We have some tips, some biggest mistakes we see people making. So lots of really cool tips. We're going to go over, I'm kind of excited about it. We're going to go over a vacancy report from CMHC, just kind of show you some of the things we should look for, some of the things we should be looking out for when it comes to analyzing a property and doing our numbers. So
now, once you've chosen your market, what about the property itself? So
absolutely,
we're not going to focus too much on the market stuff, although it kind of sometimes comes into play, but we are going to talk more about the property itself, the numbers, and, the mind games that we play with ourselves that really come and shoot us in the butt after. So, do we want to be in this long term? Do we want to be in this 10 years from now? Do we want to own that property long enough for it to be paid off by someone else? Or do we want to end up having a property that we've come to hate, went from love to hate, and that takes us out of the game?
That's pretty easy to do. We see it all the time. We see bad decisions being made on the purchase, with grandiose plans sometimes, and well-intentioned plans sometimes. But some of the points we're going to share today can stop you from maybe making a mistake that sometimes can cost thousands or tens of thousands of dollars. And hopefully you can pick a little nugget out of what we're going to talk about today.
This is a property of ours that we've had since 2007. It was one of the last ones that we bought.
It was the last one we bought.
Was it?
Yeah.
So thank goodness we knew what to watch for and knew that the market was starting to become super overheated for what Edmonton, which is our home market, could really do. So we actually stopped buying, made a conscious effort in March of 2007 to stop buying. And when we made that effort, thank goodness we did, because things started to change drastically after that. But this is one of the last ones that we bought. We bought it on a BTB, full BTB, right? Did we put any money down on this?
Full VTB, you're right.
Full VTB?
Yeah.
Which we planned to pay out within 2 years, I think, and then we didn't end up, so we had to renegotiate that for another 2 or 3 years. Anyways, then that didn't work out very well. We ended up having the tenants that had been paying like $1,400 or $1,500 a month in rent, ended up moving out, and then we realized, this is exactly what we're talking about.
We were getting $1,100, $1,200 in rent. That was it.
No, not from that very first couple that was in here.
Okay.
When we bought it from,
I see what you're saying.
Yeah.
Yes.
They were like $1,450, I think, or $1,500 even. It was like, woohoo, this is a great property. So we bought it without really analyzing our numbers. And then when they moved out a couple of years later, we realized that we could only get $1,100 to $1,200 a month for this place.
Yeah.
So again,
and that didn't cut it. I mean, we were negative cash flow at that point, and so this is not our topic for tonight. But
it fits in
you know what? It does fit because we didn't analyze the property properly, and
we got caught up in the no money down,
and we got caught up in
VTB.
the hey, we can buy it, and VTB and low, exactly, and it didn't cash flow. It was negative, so we pivoted. We made some choices that, we had some extra furniture at home. We had some extra things we were going to throw in. So why don't we bring some of our stuff here? We brought one of our older sofas, older chairs, some of our lights and stuff we had on the wall at home. We brought it here. It cost us less than $4,000. I know that, to fully furnish the entire place and get the cutlery and get the toasters and get everything that we needed to put in here. and it really didn't cost us anything, less than $4,000, and it jumped our rent from struggling to find tenants for $1,100-1,200 a month. And immediately at that time, we were getting $2,100 a month
even.
just by putting in less than $4,000 worth of furniture. So, the advertising changed, all that stuff. Long story short, it ended up working out. We love the place now, and we have it on Airbnb, and it works really, really well. But you got to sometimes pivot. And one of the points we're going to talk about today is having a plan B when it comes to your investments, because sometimes it doesn't work out the way you planned it from the beginning.
So point number one, we're going to quickly run through what we're going to be talking about today, and then we'll get through to each of those points. So point number one is know your strategy and analyze for that strategy. Our strategy was a long-term buy and hold with this property. Well, guess what? We didn't analyze the numbers properly for that strategy, and it ended up we having to pivot into being a short-term rental, and then into a corporate rental, and then into now an Airbnb as well. So listen, you have to know your market, what strategy works there, and then you have to analyze that property for that strategy. So that's point number one we're going to dive into in a little bit here. Point number two is be real in your numbers. So it's amazing how we can talk ourselves into it. We just talked about that with this place here. It was great. We were so excited. It was a full-on VTB. I don't know. I never even met the guy that we bought it from.
Yeah.
I think you might have or whatever. But it was exciting and it seemed great. But I'll tell you what, we assumed and took over a mortgage far beyond what we should have for this kind of place and that property. But we were so wrapped up in the deal and the VTB side of things and getting that deal that we didn't analyze real numbers for how this property was going to play out for the next 10, 15 years. We've had it since 2007.
Mm-hmm.
So what is this now? 2020. So 13 years. We didn't analyze it. We didn't go through it. So be real in your numbers. And we're going to talk about how to be real in your numbers, what numbers to go through. Point number three is pro forma numbers versus real world numbers. Mm-hmm. So how do you figure out what vacancy rate to use? How do you figure out what maintenance allowance to put in, property management, all that kind of stuff? How do you figure out
they're not
those
the same
numbers?
For every property.
They're not the
same for one condo to the next, or one building to the next, or one complex to the next, or one street to the next. These things can change per property. So it really is important to make sure that we nail down some of these numbers prior to us buying the property, if at all possible. Because that comes into the decision making as to, are we going to buy property A, B, or C? We have to analyze these things properly. We can buy the exact same property on one side of the street. And I did not realize this until I became a realtor and started really looking inside the numbers. But you can buy one property on one side of the street and the same exact property on the other side of the street, other side of the tracks, so to speak. And it can make a world of a difference on the amount of rent you're going to get, the amount of price that you're going to buy it for and potentially sell it for in the future. So there's so many factors to consider.
Yeah, so that's what we're going to talk about. Okay, so that's what we're going to go into a little bit. Number four is the biggest mistakes that we see people making. And then if we have time, we're going to add in a couple of pro tips, a couple of things that you can do to kind of vet your stuff a little bit better that maybe you weren't thinking, is a huge deal, but has really made a huge difference in our investing. Anyways, so number one, know your strategy and analyze for that strategy. So what are some of the things that we will do? Now, for example, this story we just told you about, this place that we bought 13 years ago, we didn't analyze it for the strategy that we were buying it for. We just analyzed it for woohoo, we can get a no money down deal.
Right. So sometimes we look at it and say, wow, the ROI is super high. If I was to buy it now and hold it for a year and
or 12 years,
renovate it, or or maybe the numbers look really good, the cash flow is not great, but the ROI is super great. Or maybe it's the opposite and the cash flow is super high, but the ROI, we're not expecting prices to go up. We're not, all of that kind of stuff. So you have to understand your strategy first of all. So you have to decide what you're going to do with that property.
So for example, with this one,
yes,
and I know I'm putting you on the spot because we didn't talk about this part, but we overpaid for this. So
absolutely.
How much did we overpay?
Well, we paid $238,000 for this particular property.
Okay.
Okay. It was a 1-bedroom condo in West Edmonton.
Okay.
Brand new at the time.
1 bedroom plus den.
plus 10. Okay. Yeah, I'll give you that.
Okay.
So we paid $238,000 for this.
Okay. What was it worth? Because it was not worth
it. Well, here's the thing. They were selling for that price at the time. They were
Okay.
selling for between
thought we
230
overpaid a
and
bit.
240 at the time.
Okay.
But you know what? When I look back in history at the numbers, the highest that any one bedroom has ever sold in this building is 250,000. So we paid pretty much near the peak when it comes to this building. Now, that's just what happened, and our timing wasn't good.
But because we didn't analyze for the strategy that we were buying in, okay? We were buying for a long-term hold. All we saw was, woohoo, we can get a break-even property. It's no money down. So let's do it.
Yeah.
But what we didn't think about was 13 years down the road, when we have this property and have had it for 13 years, if it's not cash flowing, what kind of effect is that going to have on our life?
Even $100 a month negative.
We
if
did
you were
that
to take that,
more times than you can
$100 a
count.
month negative times 12 months is $1,200 a year times 10 years. Well, that's easily $12,000. Now, what if you have 10 properties?
Or 40 or
that's
60.
120 grand. So this is where it starts to really add up the more properties you have. So you got to make sure that as you purchase, you're purchasing correctly and based on the strategy that you're trying to employ. So if I'm trying to flip, if I'm buying this at 238,000 in 2007 and I'm looking to flip it, would that be smart? Absolutely not. And this so ties in with choosing your market. We got caught up in the fact that Edmonton's market in 2004, 5, 6, and 7 was doing nothing but skyrocketing up. Nothing but skyrocketing up. And so because it was going up, we assumed it's always going to go up. And we ended up buying this one at the peak. And it's actually been worth less than $200,000 for almost the entire time we bought it. And I think right now, if I wanted to put this on the market, it'd be worth about $185,000, $190,000 at the most.
But do we care? Because we're not selling it. Now, if we hadn't pivoted and made it into a short-term rental and weren't making $700 a month off of this property, right now we're doing a little bit of renovations, so it's vacant. But other than that, even through all of COVID, it's been fully rented. So we're making $700 a month off of it. I don't care what the price is.
Who cares if it goes up or down? It could be worth $5.
High from a rental project.
But if we're making $700 a month in cash flow because we rent it out the way we're doing it now, I could care less. I'm not planning to sell it. So we're planning to hold this for a long term. That was our plan from the beginning. So whatever the prices do, go up, go down, whatever, that's irrelevant to me because we're making the cash flow on it. Now, if we weren't making the cash flow, it would be extremely relevant, right?
Yeah.
So this is where analyzing comes in, which we're talking about tonight.
If your strategy is to buy that property and hold on to it or flip it within the next, say, 3 to 5 years, whether you do work to it or not, whether you allow the market to do the appreciating or do some active appreciation, what doesn't matter which way it is, you want to get the proper comps. You want to make sure that you're getting the right numbers from the right people. Realtors, yes, appraisers, even if you're not sure on those numbers, pay an appraiser the $300. Believe me, you're going to waste far more money than that if you don't get that done. So, and then the other thing, point number one, is researching proper rents. So how do we do that? Across Canada, anyways, and I know some of you are tuning in from the States, but from across Canada, there's like RentFaster, for example, .ca. You can go in there and you can look at similar properties. So you can do an add up yourself, and then you can say, show me similar properties within 1 kilometer, 3 kilometers, 5 kilometers, whatever it might be. And they will show you what rents are street rents. Now, here's the difference. So CMHC has rents, but they're from all the big guys. They're from, Main Street and all these big guys that rent massive properties. We're just little guys. So we don't report to CMHC. They don't really reflect the kind of ma and pa rents that we get. So what you want to do is you want to find those spots. So that might be in a local landlords association. That might be, by going on something like RentFaster or whatever's in your area that tells you what average rents are posted for now. Posted, not what they're renting for necessarily, but what they're posted for. So comparable prices, comparable rents, and make sure that fits the strategy that you're looking for. Is that 13 years down the road or is that 3 years down the road? Make sure that fits. Just a little pro tip that goes along with what you're saying is, if you are wondering what would this property rent for, pretend you are a tenant looking for that type of property.
That is the easiest way to find out. If you were a tenant looking for that type of property, what would you do? You would type in, I'm looking for a 3-bedroom house in blah, 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 blah. You would hit enter and you would have your rental sites come up. Check out those rental sites, the same as if you were a tenant. Check out those rental sites and see what those type of houses are going for, those properties are going for. That's the easiest way to compare it.
Yeah.
So,
or even do a ghost ad. So you can throw
absolutely.
on a ghost ad. So and people say, well, do you ethically think that's fine? I don't know. I've never had an issue with that. I throw on a ghost ad and I just kind of say, looking to get, this much money for rent, just so may not be available for a couple of months, but I just kind of gauge the interest and see what are people willing to pay for that. So that's what you need, those numbers. Okay. It's not about VTBs. It's not about AFS. It's not about no money down. It's not about any of that stuff, because it's those things that are so attractive. But I can tell you, some of the most creative and successful investors that I know and have met in the last 20 years have also lost their shirts because they didn't analyze those properties for the strategy they're looking at. They more analyze them out of the no money down deal and how exciting and creative it can get, which is super cool and super fun, but it's not going to help you 10 years down the road. Make
so
sure
just quickly before we move on, Elaine here is asking, I've never been a tenant, so what sites would I look at? So Elaine, just simply pretend you are a tenant.
So go to Google, Google it.
Go to Google, type in the search bar, I'm looking for this type of property.
Well, you probably put 3-bedroom in, I can't remember the little area you're outside
Merricksville, I think.
Merricksville.
Something like that.
So, or in not Lethbridge, Medicine Hat, or whatever it might be. So type those in, 3-bedroom, Medicine Hat, basement suites. And that's what's going to come up, or are those sites that are SEO driven, so have search engine optimization that bring people, renters, to their site and thus your property. So just pretend you are Googling it, and what would you type in? And that's the top sites that you're going to find are right now ranking the best. And those are the ones that that, woohoo, they're going to bring
Easiest way to
people.
find that is pretend you are one.
Number 2, figuring out cash flows using all expenses. So vacancy rates. For example, we see a lot of people that will say, oh, the vacancy rate in my city. Now let's just use Toronto as an example. The vacancy rate in my city is 4%. So I'm going to use 4%. And we see this time and time again on performance. However, you think about Toronto, a city of millions of people and hundreds, tens of, maybe thousands of neighborhoods. You're using a very macro number, a number that's a bird's eye view number for a very micro property. Okay, a very micro situation. So if you think, if I used a Canadian number to signify, what's happening in my properties, you'd say I'm crazy. But yet we do the same thing. We look at a macro number, like for example, Toronto, when really when we have a certain property in a certain neighborhood on a certain street, that can have huge differences. I'll never forget how I had one investor, this was years and years ago, our vacancy rate was listed at 3% at the time. But really we were down about 1% at the time, because CMHC is about 6 months behind. And I mean, we were, we had 12 people lining up for viewings, showings, whatever. That was our market. And yet there was one pocket of the market we were investing in that was at 14%. And so there were investors just flocking there because prices were amazing on these properties. And I'm like, okay, but stop. Have you looked at the map? Let me show you. It's 14% vacancy rate. And they're like, what? Edmonton's at 3%. Like, yeah, but not that area. So vacancy rates are super important, and you need to really drill down. Where can you get that kind of information? Corey's going to show you a couple places, and then how to analyze it yourself. You have to dig deep sometimes for vacancy rates. Let me just say CMHC is usually behind. Plus, they don't really represent the mom and pops. But if you look into like your areas, your boards, your real estate boards, your tenant landlord associations, all of those kinds of places, they usually have more up-to-date and more reliable information that's a little more specific.
And here's the thing. Let's say I can't find something, okay? Let's say I do all the research and I'm buying in a town where they don't publish this kind of information. It's difficult to find. Take the information from the nearest large center, and then I would almost double it. I would almost just be super, super conservative. And that's really, really important. And that was actually, I think, point number.
Anyways, I changed it all.
One of the
Sorry.
points. So being conservative in our numbers is the most important thing of all. So even if you found that CMHC says that this particular neighborhood is at 4% vacancy, does that mean I throw 4% vacancy on my pro forma when I'm trying to figure this stuff out? No, I'm probably going to put a 5 or a 6 or a 7. Why? Because I want to be conservative. Now, these numbers, just because I put 7% on a pro forma when I'm analyzing a property, doesn't mean that 7% is coming out of my bank account every single month. And this is the important part to all of this, is that these numbers that we use on our spreadsheets when we're analyzing a property, they are just to help us analyze. They're not real world numbers. And there's a difference between the numbers that we analyze with just to determine whether it's good or not, and real world numbers. Because let's face it, if there's a tenant in that property that I bought, there's 0 vacancy. So all of that 7% or 6% or 5% that I accounted for on the pro forma is going straight into my bank account. That is cash flow. There's a difference between pro forma numbers that help us analyze and real life numbers. That's what's going in and out of our bank accounts. There's a big difference between those two. What we want to do is we want to make our decisions when we're analyzing a property super, super conservative.
So here's another way we can do that. And it's something, again, we're seeing all the time. So, a lot of developers right now and realtors and stuff are getting really smart and really great for us as investors, and that they're providing properties for us now that often include like property management, for example. So they might be a brand new property. So we think, oh, well, we don't really need much for maintenance because they're brand new and they have warranty. And secondly, they're also property managed. So I don't have to put in a number for property management. But here's the thing. They're usually property managed for 2 years, let's say, on average. Sometimes 1, sometimes 3, but let's say 2 years. So now what's going to happen after that 2 years? If you're going, like point number 1, you're going to hold on to that. And that's your strategy, to be holding it past that 1 or 2 year point when the rents are guaranteed. And when property management is included, you need to be accounting for what's going to happen after. So your pro forma, your analysis of that property needs to include, now you can then ignore it after, but it needs to include property management that's coming in, whether or not it's provided. So you need to be including that, okay? So don't, just because it's included, don't exclude that. Let's talk about maintenance for a minute. Maintenance is huge. So maintenance on on properties, we see this huge span. But you know what's interesting is there's a lot of properties that you need to be counting in about 10% of your rents for maintenance. Yet, we do not often see people, very, 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 very rarely, putting 10% as maintenance fee. But guess what? In the real world, an older property is going to have, if they have older appliances, if they've got issues of leaking roofs and windows that get condensation.
Those are big costs, right? Big costs.
These are big
so
things.
These big things come in. If we spend $4,000 on putting a new furnace in our property, for example, you divide that over a 12-month period in that year. And what does that work out to be? That works out to be several $100s a year, $350 a month roughly, that comes out of our cash flow if we have to replace it that year. So some of those big costs can really put a dent in our repairs and maintenance budget. Absolutely. And that ties in with our reserve fund. Here's the thing, guys, that I see a big mistake that a lot of investors make right off the bat is, yeah, they might account for 8% repairs and maintenance on a particular property. But if something goes wrong in that second month, what if something goes wrong in that first year and I've only collected $500 so far, and now I got to replace something big? You have to have a reserve fund. Your repairs and maintenance allowance that you're counting on are $50, $100, even $150 a month. Putting it aside might not cover that yet. So you have to have a reserve fund right from the very, very beginning. And that comes into analyzing that property. How much should I have right off the bat to do renovations, but also to set aside as a reserve so that if something goes wrong on this property versus that property over there, I might have to have different reserve fund amounts. So it comes into analyzing a property. Absolutely.
And I think you kind of touched on it, but I just want to go in a little bit more. I don't know. So as you guys, well, actually, we didn't introduce ourselves. Again, we're Corey and Tiffany Young. We're the founders of Investor Life. We've owned over 100 properties for 18 years-ish. One thing that we've learned is that you can't almost count on anything in investing. And so that's why we do this show and share with others. So, you know, one thing that we've seen a lot of is that, oh, by the way, we did everything by having joint venture partners. So people gave us our money, we invested it with them and split any profits. Now, I don't know about you, but the very worst thing I can almost even imagine is going to a partner and having to ask them for money. That stressed me out beyond words. So before I learned that the proper way to do this would be to put in a reserve fund, I just thought to myself, how, like, I don't want to have a partner and then have to ask them for money. Guess what? I never had to. You get a reserve fund of about 3 months rent worth of rent. So if rent is $1,500, you're gonna have a reserve fund of $4,500, and that's just to have it. That's not if you know of known other issues, like if you know that windows are going to be replaced, add more to that reserve fund. That's just as your minimum. And we never had to go to a joint venture partner and ask them for money because we had, if something came up, we knew
the funds were there.
The funds were there. We could sleep.
And exactly, George, you were asking what percentage would you use for a reserve fund? So we usually just use 3 months gross rent. That would be kind of a minimum when it came to what our reserve fund would be. Sometimes it was significantly higher than that if we anticipated that this could go wrong in the first year. That could go wrong in the first 12 months. So let's put the money aside for these things in the reserve fund in case they do go wrong. So depending on the property, that will determine how big of a reserve fund you go. But I would say a minimum of 3 months gross rent is what I would put aside.
And we'll just answer this, sir. We don't know who you are, but do you have separate bank accounts for each property? So no, we do not, and no, we would never. So we got to
number. Well, we did at one time.
Yeah, property number 28 with 28 different bank accounts. Total nightmare. We were told. And so we followed the advice that it's best to do it that way because then all your accounting is built in for you. Your bookkeeping is practically done for you on the banking statement. Heck no. It was a major mess and then a major mess to get out of. So no, we don't. And you have to keep that money separate. Some people say that reserve fund doesn't have to be in a trust account. No, it doesn't. It doesn't have to be in a separate account at all. It just has to be available. You know, whether you've talked to your joint venture partners, you know, how you've structured your bank accounts for you to be able to write from it. Now, let's say you have $4,500 a month, or sorry, $4,500 in a reserve fund, but you've decided that you don't want, let's say your joint venture partner, your money partner says, well, I only want you to spend, like, if it's anything over $500 or anything over $1,000, like I want to know about it. Then there's also a line in there in your agreement that says, okay, the reserve fund is $4,500, but no one item can be paid for more than $500 or $900 or whatever threshold you set without talking to your joint venture partner. But reserve funds, guys, are for you. It's hard to ask a partner for a reserve fund. You're already asking them for lawyers' fees, closing costs, down payment money, all that stuff. But trust me, you can sleep at night a whole lot better knowing that there's 5 to 10 to 15 grand, whatever the number is, sitting there for if anything goes wrong. You don't have to go to your partners and be like, hey, so
you know what, and Liz's question ties in with this. Is an available line of credit okay for a reserve fund? That's fine for a property that you might be buying on your own. What you want to do, though, is what we're really talking about here is when you're buying a property potentially with partners where they're supplying the down payment, they're supplying the reserve fund. So we want to include that as part of the cash investment from them up front. We would much prefer that than having a line of credit or something at that point. If you're buying a property on your own and maybe you're paying the down payment out of a line of credit, then having a reserve fund set aside or a certain amount of the line of credit would be fine. But if you are working with partners, I would prefer cash so that, you know, they're not having to dip into it. I'm not having to make that phone call. They're not having to write a check, all of that kind of stuff. Okay, so far we've talked about point number 1, which was know your strategy beforehand. If you're doing a flip, you're going to analyze differently than if you're doing a long-term buy and hold. Know what your strategy is, have a plan B. Point number 2 was be real in your numbers. Be conservative when it comes to your numbers, and know the difference between expected costs, vacancy, repairs and maintenance, things like that, and hard costs. You're going to have to pay a mortgage. You're going to be paying property management. You're going to be paying taxes or insurance. Those are your hard costs. Know the difference between what is going to come out of your bank account every month and what you're accounting for to come out of the bank account, what you're accounting for in your analyzation of that property. There's a difference between those two things. Okay.
So, and what that gives us, guys, is sanity. Because when we know, let's say that we have counted on $300 a month of cash flow from a certain property, but over the last year or 2 years, it's actually turned out to be more like $600 a month because we haven't had a vacancy and we haven't had those repairs and maintenance, then that's a nice bonus to get. But the opposite is a terrible bonus to get when you've counted on $600 a month in cash flow, because on paper, it looked like, yeah, your expenses, hard costs minus income, it's going to be $600 a month. And then it starts happening differently. That's really hard to take emotionally, and it can really throw you and really take you out of the game way too early. So that's why it's important. It's not just important because we're talking about, know your numbers. It's important because if you can last in real estate long enough to have your mortgages paid off by other people, the markets to go up, rents to go up, equity to appreciate, all of those things all by themselves without you having to do work, that's when really wealth kicks in and freedom and choice kicks in your life. But a lot of investors don't make it to that point because of things like this. That's why we're going back to basics tonight, saying let's analyze. We know, but let's get back
and some
to
of these
how
things,
important.
Some of these things are just small little mistakes, or we didn't think of it up front. So a great question here from Solomar, getting the reserve from the cash flow. No, we don't want to get the reserve from the cash flow because it will mean that the cash flow will not be received while the reserve is being built. Exactly. That's number 1. But number 2, you have no money there if something does go wrong while that reserve is being built. So you have a reserve and then you have cash flow. Those are 2 totally different things. And some of those things, like Tiff said, if a vacancy is if it isn't vacant or there are no repairs, that money helps to build up that reserve even bigger. If at the end of the year you find you are way over and you have more cash flow than you expected, can you split that amount? Absolutely. You can just, as long as you keep a healthy reserve fund going the life of that property, and anticipate that things are going to go wrong, right?
And what we did too on a number of properties, and we recommend doing this too, is if you got a reserve fund, let's say you got $4,500 because that's 3 months rent, and you're like, okay, that's standard. But I'd really feel more comfortable with whatever, $6,000, $8,000, whatever it might be. You can say to your joint venture partner, just for the first year, why don't we make an agreement that any cash flow that does come in for that first year gets added to, so not creates the reserve fund, but gets added to it. And now, so that you still have a nice cushion there, but now you've started adding to the reserve fund. And before you know it, within a year, you've got a couple more $1,000s in there. And that's okay to do with your cash flow. That can absolutely work. But this comes in as part of your closing costs, just like your lawyer's fee, just like your appraisals and all that stuff. There's a reserve fund fee as well.
One of the things that we wanted to go over today was showing you an example of a vacancy market report that CMHC puts out.
And how we have to decipher
some of the things that you want to look for in there, some of the things we don't want to put too much weight on it. But I'm going to share my screen with you and show you a sample one. This happens to be here in Edmonton. Why did I pick Edmonton? Because I know Edmonton, this is where we have been investing. So I'm going to show you an example. Now, CMHC does this for markets all across Canada. You can find this for markets all across Canada. I'm just showing an example of what Edmonton looks like and how you can analyze these types of numbers. It is from CMHC. Okay, so this is the rental market report, is what they call it.
And for those of you coming from the States and watching from the States, there are all kinds of some very similar reports you can get all over the place. So you just got to dig for them within your area.
So a couple things I want to go over on here. Number 1, do you notice this here, date released? Okay.
Wow.
So it's 2020. Now, one thing that CMHC does is they do their reports in October of every single year, once per year. That's October. So this was from October of 2019 till October of 2020. That's what this report will be showing. Okay, so is this today's?
Okay, and
or if I'm looking at this in April or May or June of next year, this will still be the most recent report that CMHC will have released.
And as we know, markets can change based on commodities, like our market is, based on just in-migration, like the, Toronto, Vancouver markets have changed, based on COVID.
Yes,
anything can change so
based
fast.
on the weather.
So,
Edmonton always sells less than it does in the summer because no one wants to move in the winter. So what else do we look for on here? So I'm just going to show you, and this is what we touched on earlier when it comes to vacancy rates, is that you can see the darker blue means higher vacancy, okay? The lighter the blue means less vacancy. So what you're looking for on here is light blue. The light blue areas, less vacancy. You can see in Edmonton, it happens to be around the surrounding part of the city. That's where we've always told investors to be buying in Edmonton.
For years, but opposite to what is most cities,
in a
right?
lot of other cities.
Most cities, it's the more centrally where, not in our urban sprawling city of Edmonton.
But if I was to just go and say Edmonton's vacancy rate is 4.9%, and I bought in downtown Edmonton expecting that, or in Strathcona County expecting 4.9%, and I was doing my numbers based on 4.9%, do you see what we would be getting here? Okay, we would be getting higher vacancy, much higher. That's above the census metropolitan area, which is what CMA stands for. It would be above that. So I wouldn't be doing my numbers properly. Now, what does the size of the circle mean? The size of the circle, we want big circles because big circles means it's above average rent. So when we're looking at this map, we want light blue and we want big circles. That is a very simple way of showing us what areas of the city or outside of the city in the metropolitan area we might want to be investing in. So looking at these reports, the reason I'm sharing this today is just to show you that this gives us a slight idea that one part of town can be different from another part of town.
And just like for those of you that were here when I was telling the story of how our market was at 3%, and our properties were flying off the shelves. Oh, I was just going to show, but anyways, it's still there. So that little dot, this one of the smallest ones toward the left side of the screen, Jasper Place, that was the area that had a 14% vacancy at the same time that the rest of our city had 3% vacancy, according to CMHC. Okay, so apples to apples. Now the real on the streets, we were at 1% ish, they said, which is essentially zero. But Jasper Place, people were flocking to it, saying.
That is exactly the point that I was going to make, because you look at this here, we have West Jasper Place, which is below average vacancy and higher than average rent. And we have Jasper Place here that is completely the opposite, below average rent and higher than average vacancy. Yeah. And that is such a small area that is separated there. So these are the things that are so important to be looking for.
Because if I based my numbers, if I was buying in Jasper Place, but I based my numbers based on Spruce Grove or even the Edmonton average at 4.9%, but I bought in Jasper Place, and here I find out that it's at 10%, 12%, whatever it might be, now I'm in trouble. And as an out-of-town investor, I'm in more trouble because I can't jump in and just do what needs to get done. So at the end of the day, guys, what you have to do is remember you need to get micro in your analysis, okay? So macro is looking from a, bird's eye view. Good. I've got, a market analysis. I'm looking at different markets.
One other thing I wanted to say when it comes to that rental market report, and yes, this is available for, I think, almost every center across Canada that has more than 50,000 people. Okay, so then CMHC publishes a report on it.
Even towns-ish.
Now, the other thing I wanted to say, and Tiff alluded to this earlier, is that this is the primary rental market report. Okay, so the secondary rental market report, which is all of us that have, 10, 5, 1, 100 properties, we don't report to CMHC about our vacancies. So we're not included in this report. This is just apartment buildings, bachelor to 3-bedroom plus, but it gives us a general idea. But we got to remember that the numbers can be outdated. This is for only big corporations renting apartments. This does not apply to the secondary rental market, but it can still at the same time give us a general idea of what's happening in particular neighborhoods around our city, our town that we're looking to invest in.
But very clearly, one of our main points of tonight is to say these numbers are not numbers that you can count on. You're using them, you're learning from them, but you have to dig deeper. So you want to talk to the property managers in the area and find out what is your vacancy rate as a property manager. You know, how many units do you manage and how many of them are empty? You want to talk to the local landlord and tenant boards, the local, groups and associations.
Look, are there trends occurring? Is there one area that was high vacancy and now it's low, or vice versa? Start looking at trends that you're seeing over the years. That's the point of doing this. And that's why we're talking about this tonight, is property analysis. If we're looking to buy this property over here, why is that one better than this property over here? The location of that property can make a big difference when we're running our numbers and when we're analyzing our numbers.
Guys, here's the number one mistake. I did it more times than I can count.
Who here has analyzed a property and tried their best to make it work? Tried to fudge the numbers as best they could to make it look good.
You want it to work, right? You love it for whatever reason.
If you've done that, put a Y or a yes in the comments, because you know what? We've done it. I know a lot of other investors that are successful and not successful that have done it. And it is something that we really want to try to get you to stay away from. Have you done it? Yes or no? Put it in the comments.
It's really hard not to, guys.
It's hard to find good properties sometimes, right?
It is. So it sounds like me 100% guilty as charged. Yeah. So here's a good rule of thumb, guys. When you analyze your numbers, once you've got the numbers properly put in, within the first or maybe second time, because sometimes we have to guess at a couple of numbers and then we have to go confirm those numbers and come back and make them better. But if you find yourself going back to your spreadsheet or whatever you use to analyze properties, and you find that you know what though, this place is an up and coming area, and you know what, it just got a new fridge, so I'm not going to have that, so maybe I can put 8% for a maintenance fund instead of 10% or maintenance fee. You know what, I'm going to be self-managing this one, and I'm sure I'll do it for at least 5-6 years, so I don't have to put in a property management fee at all.
That is probably the biggest thing that we see is not including the property management fee, and because I'm planning to do it myself, and that is okay. But here's the thing, chances are, especially if you become successful at this, and let's plan, guys, right from the start to become successful at this and buy more than one property, you are going to want to hand that off at some point. I promise you. Property management is extremely difficult. It's not the part of the business that you want to do.
I just had one hell of a day doing it, and I'm 18 years in, but I took it back a couple of years ago and started doing it myself.
So you have to account for the cost.
Yep. And I tell you, some days I'm like, what the hell am I doing? But it keeps me in the market. It keeps me in the know. It keeps me connected to what you guys are doing every day. So it's really important that I keep doing it. But I tell you, I was ready to pull my hair out today.
Tons of yeses. Everybody is being very honest
yeah, it's
and
awesome.
humble.
I love
Thank you guys for putting in that comment, because it is what we do sometimes, and it's normal.
If you find
what we want to do is not do that. We don't want to be doing that. We don't want to have to massage them.
But you're never going to catch yourself and be like, oh, I'm fudging numbers here. But what we do often, and this is what you can kind of catch yourself in easily, is if you find yourself going back and changing the numbers a little bit for whatever reason that you've been able to make up in your head, that might be a clue that you're too emotional about the property and that you need to take a step back. There might be properties, let's say, we'll use that example. For those of you that know Edmonton's market, let's say that you buy in some of those areas with the high vacancy and the tough tenant demographic and all of those things, because the numbers look good on paper. They do. They look pretty good. But you didn't take into account that, maybe right now you're, young and single, or maybe your kids are grown and everything's fine and you're in good health. But what if in 5 years you're not in good health anymore and you're a whole lot more tired and your career is at its biggest gusto point where you're really having to focus on it and you don't have time for the extras, or your kids are you now have kids. you got to take into account your lifestyle. So when you're analyzing a property, it's not just all about those numbers. Because if you want to be standing 18 years in, when your properties are almost paid off, and when your, rents and cash flow are actually there for real instead of just on paper, you want to make sure that you've accounted for your lifestyle so that you can make it that
is fun. Such an important point, and we say this over and over again. We've named our company after this strategy, but investing meets lifestyle. Having an investor life, you have to have a life while you do this. You have to reward yourself while you do this. You have to see some benefits from doing this. That is so important. And what we see are the mistakes that people make is that they're working their arse off trying to do these things, and they're not enjoying it at all. They do it for a year or two. They make the wrong decisions up front, and they're out of this business, and they say real estate investing sucks and it didn't work for me. Well, yes, it won't work for you if that's the way you go about doing it. So what we're trying to do here is set the bar differently. We're trying to let's go about doing this in a way that you can reward yourself now. You can enjoy a lifestyle now. You can buy the right properties that won't kill you along the way. And you can actually last the 5, 10, 15, 20 years you need to last for the cash flow, for the mortgage pay down, for the equity to all appreciate. So this is the important part that sometimes gets missed in this process.
Just going to throw in a few of these comments here. So I love this. Grant says property management is a hard cost and an expense. And if we think of it that way, that's not negotiable, whereas lots of us put it as a negotiable expense on our performance, but it's not. It is indeed a hard cost. So property management didn't account for it the first few. Yeah, we didn't either, Sean and Heidi, even with our joint ventured properties, we didn't. And I tell you, we've paid for it over the years. I've worked for many years for free for some of our joint venture partners because we didn't account for it. Because why? We were trying to push those numbers. Oh, well, if we put property management in, it's not going to cash flow, so we better not. Guilty as charged.
Solomar, 10% would be the minimum I would put in any analyzation of a property, because yes, you do have those extra charges. I would easily put in 12, 14%, but
depends
that's
on your
where
area.
It comes down to speaking with property managers prior to even making a purchase. Ask them, what are the easiest properties for you guys to manage? Maybe that'll give you a hint as to what type of properties to go forward and buy.
This is Corey's pro tips for buying these properties. So
number one, complete your diligence on that property during your conditional period. What I see a lot of people do is they are researching and analyzing and going through everything they need to go through, and they haven't even put in an offer yet. And then they go to put in an offer, and either the property is gone or the offer does not get completed for one reason or another. So you have a diligence period after you have an accepted offer, because you have conditions of inspection, you have conditions of financing, whatever conditions you put in there. Give yourself the time to do the diligence after you have an accepted offer on a property you can actually buy, and do it, cram it in there in the 5, 6, 14 days that you have during your conditional period. That's when the diligence happens. And once that diligence is complete, that's what we call you've done your due diligence.
Okay, and the last thing too, and you can make that part of your offer as well, but what you want to write in your offer for sure is that you're going to have contractors and showings perhaps come in. And can you do this in every market? No, sometimes you can't. But if you can, write it into your offer. You're going to have contractors coming in during that conditional period so that you can do, you can be one step ahead on this kind of stuff.
So hopefully tonight, guys, you got a few little nuggets here and there that can help you to make good decisions when it comes to analyzing your properties, to be real when you're analyzing them, to look at the real numbers, and to notice the difference between vacancy rates like we talked about. And there's so many different, we could probably talk about this for 10 hours straight about all the little details that go into it. But the point of it all is make sure you take your time analyzing before you buy a property. And you don't want to be stuck with something that's going to take you out of this game, because the benefits of buying the right property are awesome and it's worth it. Just do the research prior to. So we'll see you guys next week.
Cheers, everyone.